5%, which is much closer to the true average of 10% than the 0 you had for your first year. But you didn't gain a thing relative to the average during that second year. You just held your ground. Instead of falling 10% behind in 1 year, you fell 10% behind over 2 years, or an average of 5% for each of those 2 years. You're pretty much in the same place relative to the 10% average either way. The point is that rates of return and dollars earned are like miles per hour and miles traveled. You may miss the target by less each period, but because you miss for a longer time period, you can fall farther behind. What does this mean for the historical record of dollar values for investing in stocks? I'm willing to bet that you haven't seen the historical record for dollar values before, so let's take a look now. Sure enough, even though the range for the rates of return narrows with longer holding periods, the range of dollar values at the end of the holding period widens. If you start with an investment of $10,000, then you'd have just under $57,000 after the best 10 consecutive years during the sample period. That's about a 19% return each year. You'd lose a bit on average during the worst 10 consecutive years during the sample period, and you'd only have about $8,100 afterward. That 21% difference between the best and the worst period turns into a $49,000 difference, or almost 5 times your original investment. Over a 50-year horizon, when we know that the range of rates of return really has settled down quite a bit, the range of dollar values has nevertheless exploded. The worst 50-year period returned 7.4% annually, which would leave you with about $360,000. The best 50 years? That featured an annual return of 13.2%. What does that 5.8% per year mean in dollars? How does over $4.5 million sound? Yes, really. Even though the difference between the best rate of return and the worst rate of return narrowed from about 21% over the 10 years to less than 6% over 50 years, the best 50 years of stock performance would give you almost 14 times what the worst 50 years would give you. The 5.8% annual return differential really makes a difference over 50 years, doesn't it? Let's look at a 75-year horizon just to hammer home the point. Over the period from 1926 to 2012, the best 75-year period yielded an 11.7% annual return. The worst 75-year period wasn't far behind at 9.4%. That's just over 2 percentage points from best to worst. The range of rates of return has really shrunk. But how much difference in dollars can such small differences in rates of return make on a $10,000 investment? The answer may surprise you. It's almost $33 million. No, 2 percentage points isn't very much of a difference, but 75 years is a very long time. That small difference in rates of return makes a big, big difference in money earned over 75 years. Many of you have heard that a very large proportion of stock market gains over a long period of time occur on just a few days. That is absolutely true. Goldman Sachs looked at the 20-year period from 1993 through 2012. If you were invested for all 5,037 trading days during that period, then you would have earned an annual return of 8.23%. Not bad. What would you have had if you had missed the best 10 days of those 5,037 days? Your annual return would have dropped almost in half to just 4.54%. And if you had missed the best 40 days, that's less than 2 trading days per year, then your annual return would have been a negative 1.95%. The moral to the story is that the conventional wisdom is correct. You really can't make much money if you miss the handful of the best days of the year. you are much less likely to have the financial